Hello everyone, in this video I'm going to talk about the personal use of company provided vehicle. So this is one of the most common fringe benefit provided to employees by the employers, that the employers allow the employee to use the company vehicle for both business and personal use. When the vehicle is used for business related purposes, the value of the use is excluded from income of the employee as a working condition fringe benefit. If it is used for personal purposes, then the value of that personal use should be included in employee's taxable income. It is taxed for Social Security, Medicare, FUTA tax, and federal income tax. The federal income tax is optional for the employer to collect. Now, I also want to mention that there are some kinds of vehicles which, even if they are used for personal use, they are excluded from being taxed. They are kind of the vehicles like delivery trucks, moving vans, school buses, animal control vehicles, trucks that are loaded with the weight that is over 14,000 pounds, or dump trucks. All these may be used by the employee for the personal use sometimes, but the value will be excluded from taxable income because of the way they look. That's not meant to be a personal vehicle. They cannot go on vacation on that vehicle. Now, talking about the valuation methods, we said that the personal use of the company provided vehicle has to be taxed to the employee. But how will we know, how will the employer or the payroll specialist know how much to include into income? So there are methods. There are two kinds of methods. One is general valuation method, other is special valuation method. The general valuation method is the method in which the fair market value of the company provided vehicle is the price an individual would pay to lease the same or comparable vehicle in the arm's length transaction in the same geographic area for the same length of time. Now, this method is usually used when the employer provides vehicle to the employee for personal use only. Generally, because the employee's use of company provided vehicle is used for both business and personal purposes, it is important and it is advantageous that we use the special valuation methods. Now, there are three types of special valuation methods: commuting valuation method, vehicle cents per mile valuation method, and annual lease valuation method. I have highlighted the annual lease valuation method because this is the one that is commonly used by the companies. Now let's talk about each method individually. I'm going to talk about the commuting valuation method first. Now, this method allows the employer to value employees' trips, the personal commuting use of employer provided vehicle at a dollar rate. It is $1.50 one-way commute and $3 round commute. There are some conditions that have to be met for the use of this method. Condition number 1: the vehicle is owned or leased by the employer and is provided to the employee in use for employer's trade or business. The employer requires the employee to commute to and from work in this vehicle. Number 3, there has to be a written policy prohibiting the employee to use the vehicle for personal use other than the de minimis use, means just to make a short trip to a coffee shop, or that is de minimis, means very minimal. Fourth condition is that the employee is not highly compensated employee. Now, for if the company is using commuting valuation method, it is okay to use for car pools and van pools. The employer provided vehicles used to transport at least 3 employees to and from work in the employer sponsored carpool or van pool arrangement satisfies the first 2 conditions. So in this method, there is a dollar rate, $1.50 for one way and $3 for the round trip for the personal use of the vehicle. Okay. Now let's talk about the vehicle cents per mile. That's the second special valuation method. Now under this method, the fair market value of the personal use of company provided vehicle is determined as this formula. So the formula is personal miles driven times IRS business mileage rate. The IRS business mileage rate is 57.5 cents per mile in 2020. If you write it in a percentage form, it is 0.575. Okay, so that's the number that you have to remember for your exams. So how do you calculate it? Personal miles driven times IRS business mileage rate. The important thing to notice in this method is that this method assumes that the employer pays the fuel. So this method assumes that the employer pays the fuel. Okay. So if this method is used and the employee paid for the fuel, then we will reduce it from the taxable amount by the fuel cost that was paid by the employee, because the employee paid for the fuel with the after tax income, with his income that was already taxed. So we will not tax it again. So we will remove it. Whatever the cost for the fuel that the employee paid, we will remove that when we will use the vehicle cents per mile method. There is also the IRS standard fuel rate. It is 5.5 cents or 0.055 per mile. So you have to remember this number, you have to remember the mileage rate. Standard mileage rate is 57.5 cents per mile in 2020 and the fuel rate is 5.5 cents per mile. Let's do one example for vehicle cents per mile method. Now in this example, the employee has driven total miles of 10,000. Out of those 10,000, 3,000 miles were for personal use. And in this example, the employee paid for the fuel. Now, whenever you are doing these the vehicle valuation questions, always keep in mind 2 things. Who is paying the fuel and what do the method assumes. Now, vehicle cents per mile method assumes that the fuel is paid by the employer, Okay, so vehicle cents per mile method assumes that the fuel is paid by the employer. Now, in our example, the employee paid the fuel. So if the employee paid the fuel, anything that is paid by the employee, we will deduct it from being taxed again. Okay, so let's do it. So total personal miles that were driven were 3,000 miles. So 3,000 miles, and what is the standard mileage rate? That is IRS standard mileage rate. It is 0.575 or 57.5 cents per mile. So we will multiply the standard mileage rate with the personal miles, and the amount that we get is 1,725. Now, because the employee paid the fuel, we have to deduct that cost from this amount. So 3,000 miles times 0.055, which is the fuel rate that is paid by the employee, and the amount is $165. So we will deduct that, and we come up to the amount of 1,560. This is the amount that will be added to the imputed income to be taxed for Social Security, Medicare, FUTA, and federal income tax is optional. Okay. So for vehicle cents per mile, it is assumed that the employer pays for the fuel. If the employee pays, deduct it. Okay. Now let's look at the next one, which is the annual lease valuation method. Now on this screen you are looking at the table that I actually copy pasted from the IRS publication 15B for this year, for 2020. So these are the this is the table that we are going to need to calculate the taxable amounts for personal use of company provided vehicle if the company is using the annual lease valuation method. Now this table is actually divided into two columns. So if you see column number 1, you will see the automobile fair market value. Automobile fair market value. Now this is the price that the employee or the employer will pay to buy or lease a new vehicle. And then there is annual lease value. So if the price of the car is, let's say, if the price of the car is between 25,000 to 25,999, then the annual lease value will be 6,850. So we will use these numbers, but let's first have a look at what this method is and what formula is used. The annual lease valuation method is the method that assumes that the employee pays the gas. Now under this method, it is assumed that the employee pays the gas. If the employee pays the gas, nothing needs to be done. Even if you are given the information that the employee paid for the gas, you will do nothing. But if the employer paid for the gas, then you will have to add it to the taxable income, because that's an extra benefit that the employer provided to the employee. Because as per this method, it is assumed that the employee will pay the gas. But if the employer pays it, anything that the employer pays to the employee is considered an extra benefit, and we have to calculate the tax on that. Okay, so annual lease value method assumes that the employee pays for the gas. If the employer pays it, it should be added to the taxable income of employee. Again, the fuel rate is 5.5 cents, same as the previous one, and 0.055 per mile. the fair market value of the vehicle should be determined by the employer on the first day the car is available for personal use to the employee, and the fair market value should be calculated every 4 years. The formula to calculate the personal use of the company provided vehicle is lease value of the car. That this comes from the table based on the fair market value that is provided by the employer. And so lease value of the car times percentage of personal miles driven. Okay. So lease value of the car times percentage of personal miles driven. That's the formula. And remember that there is a table that is provided by IRS to calculate the annual lease valuation. It will be provided to you in the exam, but you have to remember the fuel rate, the mileage rate, any other numbers that are used in the calculation. Fair market value will be given to you. So here is an example. Here is an example. In this example, the employee Phil drives company provided car. He uses it for both business and personal use. The employer paid for the gas. So in this example, the employer has paid for the gas. But in the annual lease valuation method, it is assumed that the employee will pay the gas. So the fair market value provided to us for this problem is 24,500. This is given to us. Okay. Now the business miles that were driven by the employee were 12,300. Personal miles were 4,700. We need to calculate the total miles driven because we have to find the percentage of the personal miles as compared to the total miles. So the total miles driven were 17,000 miles. Now personal miles driven percentage equal 4,700, that were the personal miles, divided by 17,000 total miles will give you 27.65%. Now we will go into the annual lease table and see where this fair market value stands and what number we get for this fair market value. So let's go to the annual lease table again. The number was 24,500, which comes to 6,600. Our number falls here between here, so 6,600. So we will take this number 6,600 and we will multiply with the percentage of the personal miles driven, and we get the amount 1,824.71. Okay. Now the other part of this question is that the employer paid for the gas. He was not supposed to, because this method assumes that the employee will pay for the gas, but the employer paid for the gas, which is like an extra benefit. So we will calculate the amount that the employee paid for the gas for the personal use, and we will add that amount to the taxable income. Okay. So here, if the employer paid gas, that would be taxable to the employee because annual lease valuation method assumes that the employee pays for the fuel. Fuel rate is the same, 5.5 cents per mile. Personal miles were 4,700. So 4,700 times 0.005 is $258.50. We will add that to this, and the total amount that we will add into the employee's income to be taxed is $2,083.21. Practice a few more examples. Make your own examples. In some examples, just say the employer provided fuel or the employee provided fuel. Just change it a little bit and calculate it and try to practice it. But the main thing for the vehicle valuation questions is that you have to remember that annual lease valuation assumes that employee pays for the gas. If the employer paid, it should be added to the taxable income. Cents per mile method assumes that the employer pays for the fuel. If the employee paid it, it should be reduced from the taxable income. And most commonly used method is the annual valuation method. So I hope this will help you to understand the basics, and it will help you to do some practice questions. I have examples for the cents per mile and the annual lease valuation method. So hope you will have fun doing and practicing this. Goodbye and see you next time.